Everyone talks about inflation as if it's a single bad thing that affects everything equally. Prices go up, your money's worth less, bad for everyone. But here's what most people miss. Inflation doesn't affect real estate the same way it affects everything else. For real estate investors and property owners, inflation can actually be beneficial. For renters and savers, it's terrible. For home buyers financing properties, it's complicated. Understanding how inflation actually affects Australian real estate is crucial to making smart property decisions. Most people get it wrong, which is why they make poor financial choices based on misconceptions about inflation. I'm going to explain exactly how inflation affects property prices, property values, mortgage debt, and your actual wealth. By the end, you'll understand why some people get rich during inflationary periods while others get poor, and how that relates to real estate specifically. Let's start with the fundamentals. What is inflation and how does it work? Inflation is when the general level of prices for goods and services rises and the purchasing power of money falls. When inflation is 5%, that means $100 today is worth $95 in purchasing power next year. Australia's inflation has been volatile recently. 2021, 2.0% below target. 2022, 9.8%, spike caused by supply chain issues and pandemic aftermath. 2023, 4.7%, moderating. 2024, 2.3 to 2.8%, returning toward target. 2025, 2.0% to 2.5%, expected. We had a sharp inflation spike in 2022, but inflation is now returning toward the Reserve Bank's target range of 2% to 3%. This is important because property effects differ depending on whether inflation is stable, rising, or falling. How inflation affects real estate prices. Here's where it gets interesting and counterintuitive. Rising inflation doesn't necessarily cause property prices to rise. The relationship is more subtle. Short term. Inflation causes mixed effects. In the short term, 1 to 2 years, rising inflation often causes property prices to fall or stagnate because, first, the Reserve Bank typically raises interest rates to fight inflation. Higher interest rates reduce borrowing capacity. Someone who could borrow $500,000 at 3% interest can only borrow $400,000 at 5% interest. This reduces demand for property, pushing prices down. Second, rising inflation reduces real incomes. If wages are growing at 3% and inflation is running at 5%, you're actually getting 2% poorer in real terms. This reduces purchasing power for housing. Third, inflation reduces asset valuations. Property investors typically value property based on capitalization rates, rental income divided by property value. When inflation spikes, required yields increase, so investors are willing to pay less for the same rental income. This is exactly what happened in Australia in 2022. Inflation spiked to 9.8%, the Reserve Bank raised rates from near zero to 4.35%, and property prices fell in many markets by 5 to 10%. Medium term, inflation becomes positive for property owners. Over 5 to 10 years, inflation actually becomes beneficial for property owners. Here's why. Reason 1. Fixed-rate debt becomes cheaper. When you take out a mortgage, you borrow a fixed amount of money at an agreed interest rate. The principal never changes, only inflation changes. Example, you borrow $500,000 at 4% interest on a 30-year mortgage. Your repayment is about $2,387 per month, or $28,644 per year. With no inflation, you're paying $28,644 divided by $50,000 equals 57% of your annual income in repayments, if you earn $50,000. But if inflation runs at 3% per year, in year 5 your income has grown to about $57,965. Your repayment is still $28,644. Now it's only 49% of your income. In year 10, your income has grown to about $67,195. Your repayment is still $28,644. Now it's only 43% of your income. The mortgage becomes progressively cheaper in real terms. The debt is eroded by inflation, while your income grows with inflation. This is enormous. It's the secret reason why previous generations built wealth through property. They borrowed money, Inflation eroded the debt. Wages grew with inflation, and they ended up with a massively valuable asset financed by increasingly cheap debt. Reason 2. Property values rise with inflation. Property prices are fundamentally tied to replacement cost. A house costs what it would cost to build a new house with similar specifications. Construction costs rise with inflation. Materials cost more. Labor costs more. Therefore, the cost to build new property rises with inflation. This puts a floor under property prices. When construction costs are rising 6 to 8% per year due to inflation, property prices have underlying pressure to rise at least that much. Property owners can't reduce prices below construction costs for long because new development would become cheaper than buying existing property, shifting demand to new supply. Over the long term, property prices rise roughly in line with construction cost inflation. Reason 3. Rents rise with inflation. Landlords increase rents with inflation to maintain purchasing power. If you're charging $400 per week in rent, and inflation is 4%, you'll charge $416 per week next year. Higher rents make property more valuable because property value is partly determined by the income it generates, capitalization. When rents rise 4% per year due to inflation, property values tend to rise at least that much. For investors, this means their rental income keeps pace with inflation, protecting their real returns. Reason 4. Inflation reduces real interest rates. This is subtle but important. The nominal interest rate, the rate you pay on a mortgage, is different from the real interest rate, the nominal rate minus inflation. If you're paying 4% interest, but inflation is running 3%, your real interest rate is only 1%. You're borrowing at 1% real cost. If inflation rises to 4% while your mortgage rate stays at 4%, your real rate falls to 0%. You're essentially borrowing for free in real terms. In extreme inflation scenarios, real rates can go negative. You're borrowing at negative real cost. The bank is actually losing money in real terms while you're gaining. This happened in Australia in 2022 during the inflation spike. Mortgage rates were 3 to 4% while inflation was 9%. Real rates were deeply negative, making borrowing extremely cheap in real terms. Property investors and homeowners during this period had an enormous advantage. They were able to borrow at effectively negative real costs while asset prices were adjusting to new conditions. How inflation affects property owners and non-owners differently. This is crucial. Inflation affects property owners and non-owners very differently. Property owners with fixed-rate mortgages, big winners. If you own property with a fixed-rate mortgage and inflation rises, you win massively. Your debt amount stays fixed, your income rises with inflation in nominal terms, your property value rises with inflation, your mortgage repayment becomes an increasingly small proportion of your income. In extreme inflation scenarios, this becomes transformative. Someone who took out a $500,000 mortgage in 2020 at 2.5% fixed rate during the low-rate period is in an excellent position if inflation runs hot. Their repayment is $2,244 per month. If they earned $60,000 in 2020, repayments were 44% of their income. If inflation runs 5% annually, their income grows to $95,000 by 2030. Their repayment is still $2,244 monthly. Now it's only 28% of their income. Meanwhile, the value of their property has likely risen from $625,000 to perhaps $800,000 to $900,000 due to inflation and underlying demand. They've built substantial wealth. Property owners with variable mortgages, mixed winners. If you have a variable mortgage, rising inflation hurts in the short term because interest rates rise. Your mortgage payment increases. This reduces your purchasing power for other things. If you're already stretched on your budget, a rising payment can cause real hardship. However, over the long term, the debt erosion benefit still applies. Your income eventually grows enough that the payment becomes manageable again, and you're still benefiting from the debt erosion and asset appreciation. Renters are losers. Renters get hit the hardest by inflation. Rents rise with inflation, sometimes even faster than inflation if rental markets are tight. If you're renting at $400 per week and inflation is 4%, your rent might be $416 per week next year. If inflation is 7%, your rent might be $428 per week. Meanwhile, your income might not keep pace. You could experience real income loss while rents keep rising. This is exactly what happened to Australian renters in 2022-2023, when inflation spiked but wages didn't keep pace. Unlike mortgage debt, which is fixed, rent increases with inflation every year. Renting in an inflationary period is progressively becoming less affordable. Savers, losers. If you're saving money to buy property, inflation hurts because your savings lose purchasing power. If you saved $50,000 to use as a deposit and inflation is 4%, that $50,000 is worth $48,000 in real terms a year later. You've lost $2,000 of purchasing power just by holding cash. Meanwhile, property prices have risen 4 to 6%, so your deposit is now further away from your target. It's like trying to fill a bucket while someone's slowly draining it. Investors with debt-financed property, potential winners. Property investors who borrow to buy are in a similar position to homeowners with mortgages. Their debt erodes with inflation. Their rental income rises with inflation. Their asset values rise with inflation. But they have a crucial advantage. They can typically pass rent increases directly through to tenants after tenancy agreement periods end, so they don't lose real income. This makes property investors the biggest winners in inflationary periods. Construction companies and builders. Complicated. Rising inflation increases their costs significantly. Materials and labor cost more. Some projects become unviable if costs rise faster than contract prices are locked in. However, inflation eventually flows through to higher property values and prices, which can make new projects more profitable if they're selling at the new higher prices. Construction companies are squeezed in the short term, but benefit in the medium term. Case study: Australia's recent inflation experience. Let's look at what actually happened during Australia's recent inflation spike to see these principles in action. 2022, the inflation shock. Inflation spiked to 9.8% in Q4 2022. The Reserve Bank raised rates rapidly from 0.1% to 3.85% during 2022. Property prices fell. Sydney fell about 11%. Melbourne fell about 13%. Brisbane fell about 9%. The reason? Higher interest rates reduced borrowing capacity, and rising rates indicated the RBA was fighting inflation by restricting credit. However, property investors and owners with fixed-rate mortgages obtained in 2020-2021 at rates of 2 to 3% were in an excellent position. Their real mortgage costs had become deeply negative, paying 3% while inflation was 9%. Renters got slammed. Rents were rising sharply as landlords adjusted to inflation. A renter paying $350 per week in 2021 might pay $390 per week by 2023, an 11% increase while inflation was 9%, but wages hadn't kept pace. Savers trying to accumulate deposits were hit hard. Property prices were falling, but by the time they'd saved their deposit, prices were rising again. They were chasing a moving target. Construction companies were squeezed. Building costs were rising 8 to 12% per year, while property prices were falling. Many projects became unviable. 2023-2024, the adjustment period. Inflation moderated through 2023 and 2024. The RBA paused rate rises and then started cutting rates in 2025. Property prices recovered and started rising again. Borrowers with mortgages became less stressed as interest rates stabilized and then fell. However, the inflation damage was done for renters. Rents had risen sharply and didn't come back down. Rent increases moderated but remained elevated. Renters never recovered the purchasing power they lost. 2025 onward, the normalization. Inflation is now back toward the Reserve Bank's 2 to 3% target. Interest rates have started falling. Property owners who held through the inflation spike have seen their properties recover in value and their mortgage payments become more affordable. Debt erosion has been working in their favor. Renters have permanently lost purchasing power. Their rents remain elevated and are still rising with inflation. Savers have finally accumulated reasonable deposits and can buy property at somewhat lower prices than peak inflation shock values. How to position yourself for inflation.
If you understand how inflation affects property, you can position yourself to benefit rather than suffer. If inflation is expected to rise, the best strategy is to lock in a fixed-rate mortgage at current rates before rates rise. A 4% fixed rate becomes a phenomenal deal when inflation rises to 6% and rates go to 6 to 7%. This is worth considering even if variable rates are currently cheaper. Buy property with debt now before prices adjust upward fully for inflation. Once property prices have adjusted upward fully, the benefit of leveraged returns is gone. But in the early stages of inflation, debt-financed property is extremely attractive. Avoid holding cash or low-interest savings. Your cash is being eroded by inflation. Get it into assets that rise with inflation. If you're going to rent, try to lock in multi-year fixed rent agreements so landlords can't raise rent with inflation. These are hard to find in Australia, but they protect you from inflation. If inflation is expected to fall, the strategy is different. Variable rates become more attractive. As inflation falls, rates typically fall, so your variable rate mortgage will decline. Fixed-rate mortgages become less attractive. Locking in a 4% rate when rates might fall to 2.5% is poor timing. It's less urgent to borrow and buy. Prices might not rise as fast if inflation moderates. Saving cash becomes more acceptable. If inflation is falling and interest rates are rising, high-interest savings accounts become reasonable returns. This is roughly where we are now in 2025. Inflation is falling, rates are starting to decline, and the urgency to buy has moderated compared to 2022. The long-term inflation story. Here's what matters most. Over very long periods, 20-plus years, inflation is basically neutral for property. Property values rise with inflation, but so do construction costs, rents, and income. The proportional relationships stay roughly the same. The real advantage of property is debt. Over long periods with moderate inflation, debt-financed property builds wealth because you control a valuable asset with only partial cash outlay. The debt erodes with inflation while the asset appreciates. Rents grow with inflation, but your debt stays fixed. A person who borrows 80% of a property's value and holds for 20 years with moderate inflation will build substantial wealth even if property prices grow only with inflation. But this requires having sufficient income to service the debt initially, being able to hold through market cycles, accessing that debt-financed opportunity early when you're younger and can hold longer. This is why property ownership, particularly early in life, is such a powerful wealth-building tool. The mechanics, why property beats inflation. Let me show you the actual math of why property owners beat inflation while renters don't.
Property owner scenario. Year 1. Buy $500,000 property, borrow $400,000 at 4% fixed, put down $100,000. Mortgage payment, $1,909 per month. Income, $60,000 per year, taking home $46,000 after tax. Year 10, with 3% annual inflation. Property value, $671,955, a 35% increase. Income, $78,079 per year, taking home $60,000 after tax, a 30% increase. Mortgage payment, still $1,909 per month. Mortgage payment as a percentage of after-tax income, 4%, down from 5%. Debt remaining, $305,265, about 23% of the original. Equity, $366,690, or 64% of original. Net wealth increase, $266,690, or 266% return on original $100,000 down payment. This person's wealth has increased by nearly 300% while they've barely noticed the mortgage becoming easier to pay. Renter scenario. Year 1. Rent property for $400 per week equals $20,800 per year. Income, $60,000 per year, taking home $46,000 after tax. Year 10, with 3% annual inflation. Rent, $538 per week equals $27,976 per year. Income, $78,079 per year, taking home $60,000 after tax. Rent as percent of after-tax income, 46.6%, up from 45.2%. Wealth increase, $0. Spent on rent, $258,000 over 10 years, in addition to what homeowner paid. The renter is actually slightly worse off despite higher income because rent is rising faster than they expected and they have no asset accumulation. This is why property ownership is such a powerful tool for wealth building, especially during inflationary periods. The risks. When inflation becomes problematic. There are scenarios where inflation becomes very problematic for property investors and owners. Extreme inflation scenario, 8% plus sustained inflation. If Australia experienced sustained inflation of 8% plus annually, several things would happen. The Reserve Bank would keep interest rates high, probably 6% plus, to fight inflation. This would reduce borrowing capacity and might depress property prices. Real wages might not keep pace with inflation, causing widespread real income loss. This would reduce demand for housing. Construction costs would rise dramatically, making new supply very expensive. This would create shortages, but also make property investment less attractive at high costs. In extreme inflation scenarios, property isn't necessarily a great hedge. It can be, but only if you're already leveraged early before the crisis. Wage growth not keeping pace. Stagflation is the worst scenario for most people, including property owners. You have high mortgage payments due to high interest rates, but your income isn't rising fast enough to keep up. Your purchasing power falls in real terms. Renters get hit hardest, as we saw in Australia in 2022-2023. But even property owners with mortgages can struggle if wages don't keep pace with inflation. This is why wage growth is actually more important than property prices for most people's real well-being. What inflation means for your property strategy. If you're making property decisions, here's what you need to consider about inflation. If you're a first home buyer, think carefully about inflation risk. If you believe inflation will be sustained and higher than the Reserve Bank is predicting, fixing your mortgage rate makes sense. Locking in a 4% rate that becomes cheap if inflation rises is smart. Conversely, if you believe inflation will fall from current levels, variable rates make more sense. Your main protection against inflation is being in debt-financed property early. The earlier you enter the market, the longer inflation can work in your favor through debt erosion. If you're an investor, inflation is potentially your friend, but only if you can access leveraged property before inflation spikes and if your tenants can support rent increases without vacating. High inflation environments create opportunities for property investors because debt becomes cheaper in real terms while rents rise, but they also create risks if wage growth doesn't support rising rents.
If you're a renter, inflation is your enemy. Rising inflation means rising rents without corresponding income growth. Your purchasing power declines. Your best protection is to buy property before inflation spikes. Waiting for prices to come down during inflation is probably a losing strategy. If you're a saver, inflation erodes your savings, making your target deposit progressively smaller in real terms, but progressively larger in nominal terms. It's a frustrating position. Your best strategy is to minimize the time you spend saving as cash. Get into property as soon as reasonably possible, because holding cash during inflation is a losing game. Conclusion: the real estate inflation connection. Inflation's effect on Australian real estate is real and substantial, but it's more nuanced than most people understand. Short-term inflation spikes hurt property prices because they trigger interest rate rises that reduce borrowing capacity. But medium to long-term inflation actually benefits property owners, especially those with debt-financed properties. The key mechanism is debt erosion. When you borrow money to buy property and inflation rises, the real cost of that debt falls while the value of the asset rises. This creates powerful wealth accumulation. Different groups experience inflation very differently. Property owners with fixed-rate mortgages, big winners. Property owners with variable mortgages, mixed winners. Renters, losers. Savers trying to accumulate deposits, losers. Debt-financed property investors, potential winners. Understanding which group you're in and positioning accordingly is crucial to making smart financial decisions. The uncomfortable truth is that in inflationary periods, property ownership becomes even more important for wealth building. Those without property see their purchasing power decline, while those with debt-financed property see their wealth increase substantially. This is why historical periods of higher inflation often increased wealth inequality. Property owners got richer while renters got poorer. It's not moral or fair. It's just how the math works when inflation erodes fixed debts while rising asset values and rents. If you understand this mechanism and position yourself accordingly, you can benefit significantly from inflation rather than suffer from it.